Getting ready to go live. Oh, this is so exciting. Here we go. Welcome to Be the Boss of Your Money. It's 4:30. That's when I do my post-market show about personal finance, investing. We cover the stock market, what's going on in Washington, D.C., in politics with the Federal Reserve. We cover all of that here, and we do a healthy dose of personal finance, all so you could be the boss of your money. Today, markets rebounded, closed off their high. Very similar day to 2 days ago, to Tuesday. So is this just another reflexive bounce? I want to talk to you a little bit about Roth IRAs, backdoor Roth IRAs. It's they may be eliminated. That's kind of the plan. And we're going to talk a little bit about what really is an accredited investor. Lots of people are asking. A lot of people want to get in on special deals and private placements. So we're going to talk about these things, and it's going to be a good show. So here we go. Hang on to your hat. Ooh, we're going to go through a roll. No, seriously, it's going to be a good show. Here we go. All right, we're just about getting ready. You've got my notes here. Thank you so much for joining me. We've got a couple of things to talk about. If you're just joining us now, I'm Mitch Goldberg. You're watching my live stream every Monday through Thursday. We do this at 4:30. It's the post-market show. If you have any questions, please ask away in the comments. You know I love hearing from you. It's the best part of doing this. Words of wisdom, words of encouragement are always appreciated. And while you're watching, give us a thumbs up, a heart reaction, some kind of reaction. I'll get to see you. It encourages me. And you know what? Let me know in the comments where you're watching from. Those all make it more fun. So what we're going to do now is we're going to cover a couple of things. What we always do first, we cover the market. I give you the skinny and what's happening. This has been the most volatile market that any of us have seen since the early stages of the pandemic. We're thinking February and March and April of 2020. From that point on, it's been pretty much smooth sailing, not a lot of volatility. We went through basically all of 2021 with a pretty benign amount of volatility. We had a little bit of volatility in March and it went away, ups and downs, big ups and downs. But right now we're having big ups and downs, and we're having them a lot. It's just been about 4 weeks or so of nonstop big ups, big downs. And I think investors are going through a range of emotion. I think people are going through bouncing. It reminds me of the Billy Joel song. It's either sadness or euphoria. And I feel like that is the current state of investors' minds. Unless you watch Be the Boss of Your Money. If you watch Be the Boss of Your Money, you are cool as a cucumber. You're not getting worked up. You're not standing around worried, should I be in reopening stocks? Should I be in work from home, stay at home, screen stocks? We talk about this all the time. You should have both. Really. You should have both. Stay diversified. I know it's so simple. You hear that all the time, and yet people don't do it. They get carried away. Diversification is a strategy that we use to minimize risk, but it doesn't necessarily protect your portfolio in a generally down market. So you could be diversified if the Dow, S&P, and NASDAQ go down 5% each and on a given day. Odds are your portfolio is going to be down quite a bit as well, regardless of diversification. So that is what I mean. But it does help your portfolio go down potentially less, which means it could help your portfolio potentially recover quicker when things turn around. And that's the deal. We want you in a portfolio. We want you in a portfolio of investments that you could stick with over the long term as opposed to you being in something that's too aggressive, goes down a lot, you get spooked out, the market goes back up, and then you're just sitting there in cash. Okay. It's not about timing the market, it's about time in the market and making time your ally. Listen, in most cases, you know, in excuse me, these are the vagaries of going live. In most cases, okay, in most cases in life, time is not your friend. But when it comes to investing, you could make time your friend. And you know what else you should make your friend? Down markets. You should make down markets your friend, not something to be afraid of. Now, I know what you're saying. You could be watching this show and you're 70 years old or 75 or 80, or you could be watching the show and you're 25 or 35 or 45. And that's where personal finance really comes into play. And this is why, I don't like to give just blanket advice in terms of picking individual stocks or telling people what I think they should do, because I don't know exactly who's always watching my live stream. But while you're watching the live stream, would it kill you to give it a thumbs up, give it a heart or a smile, a laugh reaction, a care reaction? Come on, do it. Okay, so markets are up today. Got a couple of things to celebrate. All right. First of all, unemployment, first time unemployment claims came in a little bit lighter. So it looks like that is a little bit of strength for the employment picture. And that gets us ready for tomorrow's all important number. I know you hear this all the time, but every month we go through the non-farm payroll figures. Okay. Every month we go through this. And it's a critical statistic because labor strength is one of the key metrics that the Federal Reserve uses to evaluate and change monetary policy. Like right now, the Fed is doing something called quantitative easing. It's buying bonds, $120 billion worth of bonds every month. And the Fed has said, we want to start reducing the amount of bonds that we buy every month because it was something that we did for an emergency during the pandemic. We feel the economy doesn't need that anymore. But we just, we're trying to get the timing right. So if we get a really strong labor report tomorrow, that could actually spook the market because people will expect the Fed to taper sooner, faster, and then after that, that's called the taper, by the way. When the Fed buys fewer bonds, it's called tapering. Even though they're still buying bonds, they're just buying fewer. And then we get to interest rate policy. And then people get worried. Well, maybe the Fed has to start jacking up interest rates. This is going to be interesting because there are some Fed governors who feel that inflation is transitory and we're going to go back to, sub 2% inflation. And there are some who think that we need to, jack up interest rates right now because inflation is just too hot and it's going to stay too hot for too long. But a lot of this has to do with supply chains. Okay. And that's the other big thing. What the heck is going on with global supply chains? There are shortages in things like semiconductors, plastic components, you name it, toys, clothing. Last I checked, clothing does not have semiconductors in them. Maybe someone invented something with a semiconductor chip. But by and large, you go to a department store, you go into the local Macy's near me, and it's amazing how bare the place is. And they just don't have a lot of goods. Coming into the Christmas season, retailers have got to be worried because, that's when retailers make their money for the year is during the holiday season. Well, it'll be interesting to see how that affects the economy. So anyway, labor employment figures come out tomorrow morning at 8:30 a.m. I'm going to be watching this carefully. If there is a big move in the market because of that, I will jump on for a quick live stream tomorrow morning just to throw a quick update at you. If it's just kind of a benign number and markets are kind of flattish, I don't really see a reason to interrupt your day for nothing. We could just wait till Monday. Okay, that's when I do the show, Monday through Thursday. So that's really the big thing. So today's move in the market, you know, the Dow is up over 400 points. So let's take a look at what's going on here. Okay. Um, what did I just do? That's so not what I wanted to do. Okay, here we go. That's not what I wanted to do either. Okay. Anyway, we're going to bounce around here. Okay. Um, Let me fix my screen. Okay, that's what I want to say. So the Dow was up 338 points today. It was up in the 410s range, so it's about 90 points below where it was at its high. And this is very similar to Tuesday. The market had a nice pop up, and it wound up being down. It wound up being up on Tuesday, but a lot less. And then it created a swoon yesterday morning, and by late afternoon, we had a rocket rise right up. And then today, the market took off like a shot went up. And it went up yesterday when it was announced that Congress will extend the debt limit for about 2 months. And investors, it took away a major worry because it really looked like we could default on U.S. Treasuries. I want you to know, folks, all this wrangling over the debt ceiling is really, I think, it's like death of 1,000 cuts with faith in the U.S. economy. It shouldn't be like that, but we should never let it get so close to the debt ceiling. Keep in mind when you say the debt ceiling, you're like, oh, well, it's too much debt. The economy has grown as well. Now, debt is the highest percentage of the U.S. economy. More than 100% of the U.S. economy, and that it's the highest since like right after World War II. But it wouldn't have been this high had it not been for COVID. So it's like we fought a war. We are lucky as a nation that we were able to borrow and spend the way we did. But I'm really going on here, but the debt ceiling is a matter of raising money to pay for past expenses. Okay. We've had a lot of past expenses in 2020 and so far this year. But that's what the debt ceiling is about. And let's not wait till the last minute to do something about the debt ceiling. Whichever political party has the majority, don't wait till the last minute and then blame the other side for not going with exactly what you want. These negotiations need to start early. And that's what really, I think, gets people really pissed off and gives people a low perception of Congress overall. That's my my viewpoint. Feel free to disagree in the comments. Okay, so let's get back to the screen. Okay, so the Nasdaq was up 1%. That was up almost 1%. S&P was up 0.83%. Overall, it was a pretty good day. Gold continues to go down, so gold continues to shake off any worries about inflation. Energy, on the other hand, continues to scream inflation, and energy oil, West Texas Intermediate, almost 80, not quite there, but goes up. And the 10-year Treasury, the yield was a little higher than it was last week, so it's 1.57. Last week we were all uptight about 1.55. So the yield continues to move up a little bit. But here's something what I want to really show you, and I think this is significant. You see this? The VIX, the VIX, the volatility index, under 20. How many times have you heard me say that baby goes under 20, the market rallies? It's under 20. A lot of the worries are out of the market. I think it gives the market a chance to rally. I think it gives a chance to do some short covering. And I think it gives a chance for portfolio managers who raise too much cash who will now come in and say, you know what? I've got to invest some money. I feel a little better about a few things all of a sudden, and things were oversold. Oh, and by the way, the S&P is having a pretty good year. And if you're a portfolio manager and you're lagging the S&P 500 an appreciable amount, you've got to start putting your money to work in the biggest winners of the year in the hopes that they'll keep going up and people keep buying the same stocks. So it almost becomes a game. It's called window dressing. And window dressing is when portfolio managers buy the winners of the quarter or of the year a pretty short amount of time before the portfolio managers have to publicly disclose their holdings. So at least it looks like they were in the winners. But the other hope is that they all will go into these winners together at the same time. I'm not saying they're colluding, but this is what usually happens is they all buy the winners. Any money managers who are lagging the market, their benchmark, they buy the winners in their benchmark. And that has the effect of pushing the winners up even more, which helps the benchmark. And it also helps the managers because their stocks go up. And and that happens. And if you don't think it happens, you're probably not being very realistic in terms of how, um, market mechanics, portfolio mechanics can have an impact on the market short term. Long term, it does come down to economics and fundamentals, but we're talking about just Q4 right now. Okay. And we're just early in Q4 and we are finally positive for the week. And that's, no one's complaining about that. What else? The Russell 2000 was up 1.59%. That's this benchmark here. Russ 2K, that's the small cap stock benchmark. It's the biggest benchmark that nobody follows, but I follow it every day. And if you watch the show, you know that. And that had the biggest gain of 1.59%. It had the smallest gain yesterday, so it was a standout winner today. All right. And what else do I want to show you? Let's take a quick look at some of the market movers today. Okay. Freeport McMoran, Ford was up over 5%. Penn National, GM was up. Borg Warner, a auto parts manufacturer, was up. I'm not sure what Aptiv PLC is, so don't hold that against me. Okay. Twitter's way off its high, but that was up. LKQ was up. Haynes, eBay was up a little. eBay's actually been doing pretty well. I didn't even realize people still use eBay as a platform, but apparently they do. And Etsy. I consider Etsy one of the biggest home runs that I didn't take a shot on. Decliners of the day, Pinnacle West, Lamb Weston. Look, don't expect me to know what every single one of these companies does. Citrix, I know what they do. They own GoToMeeting, okay? Becton Dickinson and healthcare, Royal Caribbean and a reopening play, UAL down, reopening play. All right, so let's take a look at crypto. You want to look at crypto. Where's crypto? Here it is. Crypto has been on such a tear, and everybody was like, when China banned crypto, people were like, oh, that's terrible for crypto. It's all over, and what happened? Josh, I see you out there, bro. But crypto, all near highs. Yeah, today they were off a little bit, but if you think about the run that Bitcoin just had from like 41,000 to 55,000, so it's off a little bit. It's like a stock going from 41 to 55 in like a week and a half, and so it goes from 55 to 54. Big deal. All right, let's talk a little bit about a couple of other things. All right, I want to talk to you about some things besides just the market and interest rates. Those are the key big picture items. But let's talk real quick about some Roth IRA stuff. All right. People like the Roth IRA because even though, even though you don't get a tax deduction when you make a Roth IRA, the money comes out tax-free. So if you make a $6,000 IRA contribution, traditional IRA contribution, you get a $6,000 deduction. You might save, let's say, for example, $2,000. It's nice. Don't get me wrong. I'm not saying it's not a lot. Or you could go into a Roth IRA for $6,000, the same dollar amount, get no tax deduction. But in 20 years, that Roth IRA, could be worth $30,000 to $40,000, maybe even more. Okay. And then when you sell it, you don't pay any, when you take money out of it, you don't pay any taxes, and you're probably saving $10,000 or $15,000 in taxes. So do you want to save $2,000 in taxes now, or do you want to save $10,000 or $15,000 in taxes later? Because when you take money out of the traditional IRA, each time it's a taxable event. There are some advantages that a Roth IRA has. For example, a Roth IRA, the money that you contribute to it, you could take that money out without tax penalties and without early withdrawal penalties. So some people like the Roth IRA because in a pinch, you could use your Roth IRA money. The downside is you don't get to say, well, within 60 days, I'm just going to put that money back into the Roth IRA. You don't get to do that. With a traditional IRA, you could take money out, but you have to put the money back in within 60 days, and then you're okay. A lot of people take money out of an IRA saying that they're going to put the money back into the IRA within 60 days, but most people actually don't wind up doing it. But that's a story for another day. So those are the key things with a Roth IRA. Now let's talk about the Roth conversion. The beauty of a Roth conversion is a lot of people can't contribute to a Roth IRA. Either their income is too high, or they're doing so well with their 401k, and they just can't put more into. They just don't meet the qualifications to put money into a Roth. And generally speaking, it's because of how much money they make. They make too much money to be allowed to actually contribute to a Roth IRA. And that's the deal. There's no income limit to do a conversion. So let me explain something to you. If you have, $200,000 in an IRA and you make like, 175,000 plus as your joint income, 200,000, even $400,000, you could still convert your $200,000 you could still convert your $200,000 IRA into a Roth IRA, but that $200,000 is one big tax penalty. It's like income, so you might owe $50,000 or $60,000 in taxes for the privilege of that conversion. Okay, which is why a lot of people don't convert. But you better have like a good 25-year plus runway to get to help the Roth IRA grow in order to compensate you for the tax penalty to convert. Okay, so the younger you are to make the conversion from traditional IRA to Roth IRA, the better. It's just that when you're younger, you typically don't have as much money in a traditional IRA, but it still could be worth doing. We'll talk about that. All right, we'll talk about that another time. I can't get into everything today, but with a backdoor Roth IRAs, you could make a contribution to a traditional IRA, even if you're maxing out your 401k, and you just don't deduct it. You don't say, well, I'm going to take a $6,000 deduction on my traditional IRA contribution. You just don't deduct it, and then you turn around and you convert that into a Roth IRA. Okay, and that is another way to go. And you don't pay if you do it right away. You're not getting hit with a tax penalty because you didn't take a deduction on that $6,000 traditional IRA. It's called a non-deductible traditional IRA contribution. I know there's a lot of jargon here. It's just the way it is. We'll try to speak the same language to make sure we're all on the same page. Now I want to talk to you about something called an accredited investor. An accredited investor is, and the reason I'm bringing this up is because I saw somebody post something on LinkedIn today about an accredited investor. It's not that they were wrong or anything. It's just that, they didn't really explain it. So I'm wondering if this LinkedIn post was really more for other financial advisors to see, or if it was for the public at large to see. So I want to explain it. And even though you think you know what you're talking about, sometimes it pays to just go online and make sure you understand it. But accredited investors, okay, has to do with private placements. You see that private placement? Let me see if I can make this a little bit bigger. Okay, private placement. You see that over there? So it means that you could be sold securities / you could buy securities that are not publicly traded, that are not registered with the Securities and Exchange Commission. So you could buy non-registered, unregistered securities. This does not eliminate fraud provisions, by the way. It just says that to invest in a private placement, you have to have certain financial benchmarks. And the rules have been loosened up a little bit, but basically, you have to have made $200,000 for the previous 2 years, or $200,000 last year, and you could demonstrably show that you're going to make over $200,000 in the current year. Okay, and you're an accredited investor, or you could have $1 million net worth, not including your primary residence. Your 401k, your IRAs, that counts toward your net worth, just not your primary residence. So you could have $1.5 million net worth, but if $1 million of it's tied up in your home, even if you don't have a mortgage on it, so it's $1 million, that doesn't count. And the reason for that is because as far as protecting investors goes, at least if you're an accredited, at least if you're an accredited investor, it's like a tongue twister for me. You're supposed to have a certain ability to take financial risk and sophistication to make the decision about going into a private placement. Because remember, with a private placement, there's less disclosure. There's less information given to investors. So companies that are offering private placements, they don't have to give you as much information. They have to show somehow that they proved or demonstrated that a buyer of these unlisted or unregistered securities are qualified. So you might be asked for your copy of your tax return, or a note from your accountant, or some other way to verify that you are indeed an accredited investor. And issuers should do that, because I think sometimes people are so eager to get into investment, they'll just say, yeah, I'm an accredited investor. I'll sign something that says, put me in there, coach, and I want a piece of that deal. But if it doesn't work, the issuer could be, and any intermediary like a broker could be on the hook for litigation, and they definitely don't want that. Okay, so when it comes to, I'm just seeing if there's anything I didn't cover here. All right, but I said $200,000 income, but if it's joint income, then it's got to be $300,000 for the last 2 years. So a little bit of a difference between an individual and joint filing. So that's what that is. But my experience with accredited investors is not, from what I've seen, it's not something that I think is so much of a blessing as it is a curse. I think when you're an accredited investor, you are, in some ways, with non-listed or unregistered securities, you are open to being taken advantage of. I've seen a lot of junk, a lot of schlock, a lot of crap sold to millionaires just because, well, they're millionaires and they could afford to lose money. That is not a great way to go about this business, and it's really, really a bad way to go about it. So what we need to understand is that just because someone is an accredited investor, that doesn't mean they have the sophistication to evaluate a private placement. You could take a lawyer or an accountant or some other profession, or someone who owns a business, and they've accumulated wealth in their business, but it doesn't mean they understand someone else's business. And I find that, people who are selling private placements are selling private placements because they don't have to disclose as much. And if you don't have to disclose as much, you're selling inherently riskier securities. And if that, and you're basically selling the sizzle to people without all of the disclosure of the risks. So that's why I think sometimes, as an accredited investor, you may have a target on your back for unscrupulous salespeople. I know a lot of people don't describe it that way, but I've seen this before. I've been in the industry for 32 years, and one of the reasons I know so much about my industry is I have a lot of experience, but it's because I've seen so many people do things right and I've seen so many people do things wrong. And when you put those together, that's when you really learn a lot. So that's my story. I'm sticking with it. I think we're at the 30-minute mark. Yes, we are. So I appreciate you taking the time to watch. Remember, the non-farm payroll figures come out tomorrow morning at 8:30. If there's like a major move in the market, I'll be on tomorrow morning. I don't know, maybe 10, 11 in the morning with a quick update of what's going on and why. If the market takes it in stride and it's no big deal, then you'll see me Monday. Really appreciate you joining me today. As always, you stay well and keep an eye out for more information like this. If we're not connected on LinkedIn, Mitchell Goldberg, LinkedIn, YouTube, that's Client First Strategy on YouTube. Instagram, it's at InstaMitchG. And you can check me out in all of those places, whichever your favorite platform is. All right, I'll speak to you soon. Thanks.